if we get started with our next panel, and we'd like to start off with Dave Amato from Division of Market Oversight. David, if you will, please.
Thank you for the opportunity to speak today. My presentation is going to be sort of a generic overview of Kansas City and the Chicago market, and then my colleague Nicole is going to kind of drill down. So this will just be the generic overview. The first slide takes a look at open interest at Chicago and Kansas City. This is all futures and options combined open interest, AFOC open interest. The blue line is Chicago and the green line is Kansas City. And you can see over this 10-year time period, we've had a tremendous increase in open interest. At Kansas City, the open interest today is about 3 times greater than it was in the year 2000. It went from about 300 million bushels to about 1 billion bushels over this time period. And as most of you know, the production tends to be in the 750 to 900 million bushel range for hard red winter wheat on a year-to-year level. Chicago also has seen tremendous growth over this 10-year time period, going from about 800 million bushels in the year 2000 to over 3 billion bushels currently. So that's almost a 4 times increase since the year 2000. The U.S. production for soft red, which is traded on the Chicago Board of Trade, is in the range of, say, 280 to 400 million bushels per year. So despite the soft red winter crop being much smaller, which trades on the Chicago Board of Trade, that's the contract that has the large open interest. So we have a contract at Chicago and Kansas City that's been expanding, but we have had at times performance issues, and that main performance issue has been the weak convergence, which we've talked about quite often. So the next slide deals with some of the side effects that we see when we have poor convergence. The first one being price discovery is weakened. When you have a consistent weak basis, and we're seeing futures 80, 90, sometimes in Toledo in the past, in Chicago it was $1.50 over the cash market. Clearly there's a disconnect between what we're seeing in the cash market and what we're seeing in the futures market. So the idea that people can look to the futures for price discovery, obviously there's a disconnect there. Hedge effectiveness, if you're a producer and you're used to having your basis be 30, 40 cents under, and now you're having a very volatile basis, a basis that's now $1.50 under maybe in Kansas City, obviously that reduces your hedge effectiveness ability. Third point, crop insurance programs. The USDA crop insurance programs, when they're trying to calculate potential revenue that a farmer can receive in a year, they use the futures price. So if that futures price is potentially overstated, if there's this disconnect between the cash and the futures, and futures appears to be overpriced, it's overstating what the potential revenue that a farmer would be receiving, and therefore it sort of disrupts the insurance program, and the farmer won't be getting the protection that he actually should be getting because his real price is far under what the futures price is showing. We've talked to several ag banks that have talked about ag lending credit crunch due to this volatile basis. And finally, the forward contracting. We've talked to elevators that have sort of reduced their forward contracting based on some of the volatility in the basis and the weak basis. The third graphic would be an overview of sort of the supply and demand. This is the U.S. wheat ending stocks as a % of annual use. The blue bars are the hard red winter on Kansas City. The red bars are the soft red winter, which is traded on the Chicago Board of Trade. If we just kind of highlight the last 2 years, 2009-10 and 2010-11, 2010-11 being a prediction by the USDA. Just to give you a quick primer, the bigger the numbers, the more ample supplies. So you can see the last 2 years for both Kansas City and Chicago, we've seen a tremendous amount of what is considered the ending stocks to use ratio. If we look at 2009, the hard red winter stocks use to ratio was about 48%, and for soft red winter it was about 66%. And then now this year, we see that Kansas City is expected to be just about the same area, maybe slightly a little bit more. Obviously, this is a long-term projection. And the soft red has come down substantially from the 66% ratio down to about 44%, But still, if you look on this graph, that 44% would be a very, very high number. So even though it's come down, we still have relatively ample stocks being projected. Now, this number came out earlier in the month with what we're seeing in Russia. Maybe that's going to change rather quickly, but at least when these data was published, it was looking at fairly ample stocks for both Kansas City and Chicago. If you can take one thing away from the briefing, I think this would be the graph that I'd like you to sort of remember. This is basically looking at the July expiration that just happened back about, well, 2 or 3 weeks ago. And it's looking at a moment in time, so it's trying to compare the July expirations that we've seen for over the last 10 years or so. The green dot there is 2010. The blue triangle is 2009. The bars that you see is a high-low range for 2008 to 2000, and the red is the median over that same time period. The portion on the left that's highlighted, that's the hard red winter Kansas City, and the portion on the right is the Chicago Board of Trade contract. And the thing to focus on is the green dots. Obviously, for the Kansas City section, you can see for this expiration that we just had, we see a very, very poor convergence. Kansas City went off the board. These are truck bids, just to keep everything consistent. And it went off the board in the 70-cent range. You see Salina, Hutchinson, and Wichita all in that 100-cent or under range. Meanwhile, on the Chicago side, you can see where we were last year, which would be the blue triangles, on the low side of the range. However, this year, the 2010 in green, you can see we're very, very good convergence, pretty much right on that zero line for the 3 main points. So, you know, I'll let maybe Dave or Steve comment on the causes of this. But the one thing that we can say with certainty is that the Chicago Board of Trade has instituted the variable storage rate, which I'm sure Dave will highlight and Nicole will talk about as well. We do have the difference, if you remember the graph that we showed on ending stocks, where we showed the ending stocks decreasing a bit, being a little bit tighter for soft red, so that's another factor into this equation as well. But Chicago has definitely seen an improvement over the last year. I believe there's been loadouts in the March, May, and July expiration, which would imply that at least at certain locations on the Board of Trade contract that there is convergence happening. So that is obviously very good news. The last 2 graphics deal with positions, and it's sort of a controversial topic, and I know it was covered in the cotton conversation. And what this graph is trying to show, it's a little busy, so hopefully I can make it a little clearer. It's actually 2 graphs on one sheet here. And what we're trying to show is the Chicago Board of Trade commodity index traders. I'll refer to them as CITs. And this would be looking at their all futures and options combined positions and their percent of open interest. And on the bottom of the graphic here, we have the nearby price and the basis. So just to kind of further give you a little bit of idea of what the graph is showing, the blue line is the CIT positions in net contracts, and that refers to the y-axis on the left in blue. And the more yellowish line is the CIT percentage of AFOC open interest. That's also a net percent, and that's the axis on the right side in percentage. And then again, on the bottom, the green is the CBOT nearby wheat price, and that bleed that you see coming off of the wheat price in red, that's the basis under the future, cash basis under the future. We've heard many people sort of target the commodity index traders as one of the main culprits in causing this disconnect between cash and futures, as the conversation that we heard previously, people talking about a massive passive traders that just have gigantic positions, and no matter what the price does, they don't necessarily change their position very much. Looking at this data, we don't really see the smoking gun. If I wanted to highlight a section, if we take a look at the 2008 period, you can see a very weak basis. You see that red bleeding off of the green line, and you see very poor convergence in that section. But then if we go up and look at what the CIT actual positions were doing, for a good period of that time, they were drastically reducing their percentage of the open interest and drastically reducing their actual net contracts. So the idea that it's a cause and effect, at least in that 1 year that on this graphic, you don't see that. And then again, if we highlight another section, the 2010 period, you can see as that green line basically makes the red line disappear, you're not seeing a weak basis anymore. And the CITs, in terms of net contracts, have basically close to record positions. Their percentages on the high side as well. So it's a mixed bag. We're not seeing exactly that sort of cause and effect that some people have postulated in the media, and maybe this requires further study. I think it's pretty obvious that someone being this large, traders being this big, they're going to have some impact on prices. But in this rudimentary type of analysis, we're not seeing it, at least in the Chicago market, and I'll get into the Kansas City market here now in a second. If we look at the Kansas City market, it's the exact same setup in terms of the graphic, the positions on the top and the basis bleed on the bottom. Now here, one could say that there is this cause and effect possibility. We see that currently in Kansas City, positions have, over the last year or so, have increased a lot on a net contract basis. Percentage, though, has remained relatively the same over the last couple of years, anywhere from the low 30s to the mid 20s. But definitely you can see that starting in about 2009, we started to have this weak basis start to occur. So that part, people would say, oh, there's your smoking gun. However, if we look at other sections of the graph, namely the 06 period to say the 08 period, there were at times where we had very large net contracts in a relatively high position, and the basis was working wonderfully. So I think that if I may make just an opinion, it would appear that the market fundamentals have the main impact on whether we have convergence or not. Obviously, like I said earlier on the slide previous, people that have positions of this size are going to have an impact. But I think overall, the market fundamentals overpower the size of these positions. And that concludes the presentation. If there's any questions, I'll be happy to try to answer them.
Thank you, David. I think in order to expedite things, I'm going to let all of the panelists go forward before we do any Q&As. And with that, Nicole, if you could give us your presentation.
Thank you for having me here today. I'm going to continue talking about the hard red winter wheat futures contract, and specifically about the convergence problems that Dave just addressed. So first, what's at the root of convergence? Well, the futures market links to the warehouse receipt market, and the warehouse receipt market links to the cash market. And between the warehouse receipt market and the cash market is where we're seeing a linkage breakdown. So first, let's focus on the futures market and the cash market. Now, we don't expect the futures markets to exactly replicate the cash market. There's frictions in the marketplace. So we have storage, transportation, different market dynamics, buyers and sellers. But what we do expect in the futures market to reflect a supply, demand, and the quality fundamentals of the underlying crop. So for the warehouse receipt that lies between the cash and the futures market, this is the instrument that's delivered by the seller to the buyer at expiration. So you're not getting delivered a rail car or a truck filled with wheat, but rather this warehouse receipt that's giving you the right to this grain. Now you can hold this receipt for as long as you want, as long as you pay the storage cost of 4.5 cents per month. So this warehouse receipt is the linkage mechanism between the cash and the futures market. It's the right, but not the obligation to load out the grain. So incentives are right now that we're seeing in the marketplace is for the warehouse receipt to be held and not loaded out. So basically what happens is you're holding on to it and not exchanging it for the underlying wheat. So the question is, why is this happening? What are the incentives for you to hold on to the warehouse receipt? So I'm going to walk you through a brief example here. So let's say you are long the March futures contract and you take delivery of the warehouse receipt. You can buy that warehouse receipt then at $4.96. At the same time, you're going to sell the May futures contract short because you can deliver this warehouse receipt on the next futures contract as long as you pay the storage cost of 9 cents for those 2 months, giving you a 2-cent profit. Over your original investment, $4.96 will give you about a 2.5% return, annualized return. Well, in this low interest rate environment, this is pretty attractive. Now, this strategy is not just a one-time thing. You can repeat this strategy. So let's say at the end of March, the spreads are attractive. You can close out your May futures contract and roll it forward and sell the July futures contract. Now you have more storage fees to incur for 4 months, but you come out with a profit of 5 cents over your original investment, which was still $4.96, giving you about a 3% return. So again, the strategy is to hold on to the warehouse receipt and not exchange it for the wheat in the cash market. So it's not linking the cash and the futures market. So this optionality feature of the warehouse receipt creates a wedge between the cash and the futures market. The futures market starts to value the warehouse receipt, and the cash market is solely valuing the underlying cash commodity. So the larger the optionality feature, the larger the value of the optionality feature of the warehouse receipt, the larger the wedge you're going to see. Now the question is, can we see this in the data? Yes, we can. So on the vertical axis here, we have the number of warehouse receipts. And on the horizontal is the expirations of the futures contract. So our blue line, or our blue bar, is the number of warehouse receipts issued at each expiration. And the red is the number outstanding. So the difference, the red being over the blue, is the amount of warehouse receipts held over from expiration to expiration. So at the end, towards the right, you can see in the 09-10 crop year, there was a large amount of warehouse receipts being carried over from expiration to expiration and not being redeemed for the wheat. So not connecting the cash and the futures market. So this is consistent with the incentives of the return that we just talked about. Now,
Nicole, just a clarification.
Yes.
This is on what contract now? This is
the hard red winter wheat, yes, from Kansas City. Now, all parties are acting in their best interests. The warehouses aren't issuing receipts because they know the grain isn't going to move anywhere. So they don't want it filling up their warehouse and then possibly disrupting their merchandising business. Likewise, the warehouse receipt holders aren't loading out the grain because it's in their best interest to hold them and earn this return in the futures market. So the question is, how do we remove this wedge? Well, left alone, market fundamentals will eventually change. So either we'll have higher interest rates, the spreads will eventually tighten due to a tighter crop or additional near-term demand, or this strategy can be made less profitable. You can make higher costs through seasonal storage rate or the variable storage rate. Or you can limit the terms of the warehouse receipt. You can make it expire, devalue over time, make it non-transferable, or you can add additional delivery options. So this concludes my brief example of the warehouse receipt in Convergence connection, and I can answer questions now or later.
Thank you, Nicole. I appreciate that. And I'd like now to go to David Lehman from the CME Group to talk about the experience that we've had with the Chicago soft red wheat.
Thank you, Chairman Dunn and Commissioners Summers and Amalia. It's a pleasure to be here today. I'll try to speed through this a little bit because I know we're short on time. What slide 2 shows is a little background of the issue. We began seeing convergence inconsistency in 06 and it lasted through 09. We've made a number of contract changes, implemented shipping certificates as a delivery instrument instead of a warehouse receipt. New delivery territories and seasonal storage rates were implemented. And then finally, variable storage rates were implemented effective with the July 2010 contract. Also improved quality specifications by lowering the vomitoxin allowed in deliveries. Results of all of these changes, we had good convergence in the March, May, and July expirations. As Dave said, we have had loadouts against each of those 3 expirations in some of the delivery territories. We've seen the calculated FOB elevator values at delivery equivalent in March of this year, and USDA cash bids at delivery equivalent in July of this year. We've also seen strong growth in volume and open interest in the contract since VSR was announced, with open interest up about 47% and year-to-date volume up 20% through June. And that's grown a little more. I got an update this morning. It's now up about 29% as of this morning's volatility. Slide 3 explains how VSR works. I won't really walk through this, but it essentially allows the storage rate to increase by 3 cents per bushel per month if the nearby spread as a ratio to financial full carry is 80% or greater, and then also allows storage rates to decrease by 3 cents per bushel per month if that spread is 50% of financial full carry or less. And it's interesting right now, we're monitoring for this September-December spread. That's running right around full carry, about 100%, 105, somewhere in that range. But if you look out into the DC-March spread, we're about 50%. March, May, July are flat right now. So it's going to be very interesting, I think, to observe how VSR works as we get into this environment in the 2011 part of the forward curve, where we have a very flat market. Just to give you a visual of the July expiration, these are cash bids at the various delivery points. Chicago, I know there are a lot of lines here. The top dark blue one is the New Orleans Gulf. That should always be a premium to Chicago because there's a transportation differential embedded in that price. And then the various delivery points: Chicago, Cincinnati, Mount Vernon, Ohio, the Gulf, Toledo, and Memphis on the Mississippi River. The Northwest Ohio is not represented here, and that was a shuttle loading location that we added in 2009. And that's a location that we've seen very active deliveries and also loadouts against canceled certificates in that location. But as you can see, we have a few points above delivery equivalent value and a few points, delivery points below delivery equivalent value. And what we expect, and as we go through an expiration, is that we'll converge to the cheapest to deliver location. The next 2 slides are just the May and March contracts. I really won't talk much about those. We didn't have quite as good a convergence with the cash bids. Again, this is a number that we talked about last fall at the meeting here, that these aren't always the best representation of whether an elevator is going to make delivery. It's really what they can sell the wheat for in the cash market that should be compared to the futures price. And that's this calculated FOB value in Chicago, which is slide 7. And this was the first snapshot of this data, the first collection of this data that we were able to provide. It showed, convergence back in mid-February and very close to delivery equivalent value through the March expiration. Just to drill in a little more into the composition of open interest in the Chicago wheat contract, this chart plots the supplemental commitments to traders or commodity index trader data that CFTC began collecting and reporting in 2006. The red dashed line is open interest. You can see a very strong growth in open interest, and we're up near record levels of open interest, and this growth upward has occurred since late 08 or early 09. What's also encouraging to see is the middle dark blue line is the commercial hedging open interest in the contract. The top gray line is a trend following fund or non-commercial. It's not the index fund, but it's other non-commercial traders. They're beginning to converge, and that's what we want to see. We want to see a even distribution of open interest between non-commercial traders and commercial hedgers. The index portion is the lighter blue line, and it has stayed relatively constant in terms of its percentage of open interest. Just another snapshot to see that our open interest is maintaining or growing actually since VSR was announced, and year over year. We looked on July 20th of this year. Total open interest 583 versus 421 when VSR was announced, so up 38%. Commercial short open interest up 34% since VSR was announced. Commercial long up 137% since VSR was announced, and index long up 22. So I think the most encouraging number here is the commercial long open interest that's really come back into the market since VSR was announced, and VSR is thought to perhaps benefit the short hedger or the seller who may earn greater carrying charges as a result of increased storage rates. But yet commercial long traders are embracing the improved convergence, it appears, as well. Another concern that we've heard about VSR is that it's making the deferred spreads more difficult to trade and more difficult to price because of the uncertainty of what storage rates will be in the future. So what we've done in slides 10 and 11 is look at, we've calculated a ratio of deferred open interest to nearby. And we've gone back 5 years with that data, and are showing the 5-year average as the purple line. The 2010 number is a light blue line that stops over here in May. When we did this analysis, we were only through May, and then the 2009 number is the orange line. So that chart's a little hard to read, but the next chart gives a table of the actual data points behind the chart. And what I'd like to point out is that since VSR was announced, this ratio of deferred to nearby open interest is at 58.9%. And the average over the 5-year time period is 41%, so we're well above that average. And we're almost at the maximum with the exception of 2007, 2008. And these are looking at the same time periods, December 1 through May of each of these years, since that's the time period that we've had since VSR was announced, and the period of time that the market has possibly had concerns about how to price deferred spreads. So just another indicator that looks like we're tracking or we're holding and, in fact, growing the open interest in those deferred months. This is the same chart that Dave showed, only this is just the softwood winter wheat. In addition to the stocks-to-use ratio, it also includes ending stocks themselves. So we have seen a significant drawdown in ending stocks in the softwood winter wheat market. We think that certainly has been a big factor in why we've seen this improvement in convergence. We had lower planted acreage last fall because of wet weather during planting period, and as a result, lower production. So to kind of sum it up, to give what our view is in terms of improved performance of the Chicago contract, we think it has a lot to do with the additional delivery points that we added that are more in the primary production and flow of wheat. We think it also has a lot to do with the changes in the fundamentals of the market. And we think variable storage rate has contributed to that as well, but it's really too early to give much of the credit, I think, to VSR. Commissioner Dunn, I know we're running behind on time. I included a slide that you suggested when we last spoke that I might about what our current activities are with regard to the swaps market, and we look forward to providing comments and to Mr. Heitman's presentation. But as you know, and I'd just like to let the committee know that we have a pending or a petition submitted to the Commission in April of this year to list another 12 agricultural swaps in addition to the 9 that we already have listed. We also have submitted a petition to the Commission to request an exemption from the ag trade option rules for cleared OTC ag options. So if OTC ag options are brought into a clearinghouse and in the same conditions that are applied to ag swaps, such as reporting daily settlement prices, mark-to-market, daily mark-to-market, volume and open interest, market surveillance, we think those conditions would actually provide just as much security, if not more, than the Commission's ATO program does. And so we have those 2 petitions on file. Thank you very much.
Thank you, Mr. Lehman. Mr. Borchard, if we could get you, and then we'll go right into Mr. Campbell, since you're tag teaming us today.
Sure. Mr. Chairman, Commissioners and committee members, the Kansas City Board of Trade appreciates the opportunity to come before you today to discuss the weak basis issue on the hard red winter wheat. My name is Jeff Borchard. I'm president of the exchange, and with me today is Steve Campbell with Lewis Dreyfus Corporation. Steve is also our vice chairman and a member of the wheat contract committee as well. Over the last couple months, we've had many visitors and guests where we've had discussions, and input has been received from interested parties concerning the weak basis issue in hard red winter wheat and lack of convergence, including CFTC commissioners and staff. We've had National Grain and Feed Association the Kansas Grain and Feed Association, Kansas Association of Wheat Growers, and we've also had some discussions with members of the American Bakers Association. The exchange understands the concerns that have been expressed by all these parties regarding the weak basis issue and the lack of convergence at the delivery during the delivery month and here of late. And we've tasked our wheat contract committee with coming up with proposed solutions to foster better convergence. The Exchange Wheat Contract Committee is made up of a balanced, diverse group of industry commercial market participants. We have millers, we have exporters, we have grain merchandisers, we have elevator operators, and we also have Futures Commission merchant members with commercial grain customers. This committee has for many weeks now been actively and deliberately reviewing the Kansas City hard red winter wheat contract for consideration of structural changes to the contract to foster better convergence during the delivery period. Many weeks ago, the committee came to the decision that doing nothing was not an option, that something had to be done with under these circumstances to foster better convergence. The committee is aware of and has been looking at many different options available to them to foster convergence, and many of those have been discussed in prior years relating to the soft red winter wheat contract with their convergence issues. So they're looking at those proposed alternatives that were discussed as well as others. Some of the more material potential fixes have a common theme, and that is it moves the basis volatility into the future spreads. You can do that one of 2 ways. You can come up with more immediate convergence types of fixes that drop it into the front month spreads, or you can come up with more gradual fixes that feather in over time and achieve convergence over a longer period of time. What the committee is endeavoring to achieve is a balanced solution that fosters convergence during the delivery period without creating unintended consequences for market participants either on the long or short side of the market. The committee has, and I've sat in on committee meetings since 1993 when we first added the Hutchinson delivery point in 96. The deliberations began in 93, and I can tell you over the years their primary focus, and think correctly so, has been to offer packages of changes, structural changes, that provide the requisite balance to the contract so as to equally disincentivize longs and shorts from making or taking delivery and incentivizing them to liquidate their futures positions and foster that convergence. We've received quite a few questions here of late about the deliberation process that the committee goes through, and I wanted to kind of expound on that a bit. Historically, the Wheat Contract Committee has met in private to deliberate and hash through the different alternatives, which is the process that they're going through right now. What they're trying to do is come up with consensus, or at least near consensus to be able to offer thoughtful recommendations to the Board of Directors for implementation of structural changes. At the time that they get to the point where they achieve near consensus or consensus on that, what they've traditionally done is at that point invite in outside parties to come in and go through the process that they've been through, the discussions, and the ultimate conclusion that they've reached, so that they can receive input from the outside parties to make sure that there's something that they haven't missed before forwarding it on to the Board of Directors. At the time they forward it to the Board of Directors, that proposal then goes public in the form of a circular that we put out that lets the market participants know that the Wheat Contract Committee has made a set of structural change recommendations to the board, and they have an implementation date proposed, and it's to put all market participants on notice that if you intend to transact business in that effective contract month forward, that you'll be subject to the new terms and conditions, assuming membership ratification and then commission approval. So that's kind of an overview of what we're facing right now, the committee's challenges, and what the process is. And what I'd like to do now is turn it over to Steve Campbell, who can, for the benefit of the committee members who we haven't had one-on-one discussions with, can maybe enlighten you a little bit as to the factors that influencing the weak basis situation right now. Thank you.
Thank you, Jeff. I too would like to thank the commissioners, Mr. Chairman. Thank you for visiting us in Kansas City, and certainly Commissioner O'Malley and Commissioner Summers as well. Honestly, I think today that the market has, whether we're talking about cotton or wheat or Kansas City hard wheat, has in essence covered the basic foundation of where we are in the market today. We are in a marketplace that is in transition. We are in a marketplace that has seen massive investment into our, into the marketplace over the last 4 to 5 years. We are a marketplace that has gone from serving a traditional producer with a traditional consumer, with a speculator that would ease the price transfer between the two, to today, which we've all discussed and or had discussion about, to today trying to also serve an investor that has created commercial demand and wants a place to hedge that demand, that risk. And so he's come to our markets and the commodity markets to lay that off. So we are in a transition. We are 150 plus exchange that is slow to necessarily at times respond to transition, to those changes. But that is also with some understanding that unintended consequences can come about by making irrational changes subject to, certain fads in the marketplace, so to speak. Again, sort of in the interest of time, I think David did a good job of illustrating the marketplace as it is today. I think Nicole did a good job in saying where's the breakdown. We understand that, the deliver economics link the cash market with the futures market. Today we have strong, massive growth in our futures market, and in the hard wheat specific market, we have free stocks growing to historical levels. In past years, when we had those same surpluses in the market, we had the farmer moving towards a loan program that would maybe then go to the Commodity Credit Corporation stocks, and a lot of those stocks would be held off the market. The farmer could still get operating loans and get his loans and move forward. Today, that's not in the case because prices aren't allowed to break that low because of this massive influx of, so we have a divergence going on between our demand for our futures contracts and that balance sheet in conjunction with the overall demand of the balance sheet and the supply-demand situation in the real physical market. So delivery economics, we understand that delivery economics allows us to cap the upside to premiums. That is to say, I can always buy option price, my freight to the location I need it, caps the high side of where premium should go. We also understand that delivery economics should cap the downside to premiums, meaning I can sell option price. My freight to Kansas City market, for instance, is 50 cents, so therefore premiums at my location should never go below 50. Now, we have also, any of us who have traded cash markets, any of us who understand those markets, understand that there's an asterisk on the capping of premiums to the downside. And that is to say, when my elevator is full, where do I go with the next bushel? So we look at it and we say, well, we need to clear it. So wheat has to go and find the next home or the next place where it can go. So delivery economics, while we understand their function, they also, have some, the downside to premiums have some linkage problem there naturally. We've seen that before in other years, but again, the futures market responded such that, such that the effects of that break in the linkage weren't felt as bad. So the cause, really, I think the cause for lack of convergence under the current contract design is due to the fact that the wheat markets have experienced a structural demand shift in the balance sheet for futures without a corresponding structural shift in the consumption of physical wheat. So we have this strong growth in the futures. We have this strong growth in our free carryout of hard red winter wheat. The farmer, is selling it, and he wants a place to go with it. So we've got a huge, massive storage issue throughout the Midwest this year. So consequently, our warehouse space, whether due to constraints on actual physical space or to the constraints on credit and position limits. It's not just that my elevator's full, it's that I'm at my maximum credit exposure with my bank because, I've got the future sold, but I'm getting margin calls. He's wanting to know if it's going to work. We got a problem with convergence. All that's tied together. So it is definitely a stress on the system because of the overall space. If you look at Kansas, Colorado, Nebraska, all the surrounding space, for this year we're projected in the fall to be 115 to 120% of the total space. Now, we can always, say, well, we'll take Milo and put it on the ground temporarily, or we'll do some other things. But the market becomes a bit concerned about that because really, are we comfortable with convergence? So there is a breakdown. It is pressed on us because of the space utilization. In previous years of surplus, future prices have responded. Wheat was put under loan, maybe forfeited, and held by the CCC. That situation is not there today because of the strength in the futures market and the break in the linkage. So we have this structural change, a massive demand for our futures. We have this year a very high growth in our free stocks. We have a great deal of pressure up on the space, elevator space in the interior. And we have a market that's concerned down the road, are we going to take care of this lack of convergence and actually fix it? So that is also putting pressure on the markets today. Kansas City futures contract was designed for a pre-index investor marketplace, i.e. it has, as Nicole and David point, a fixed storage rate, and thus it has a fixed financial full carry. So as Nicole pointed out in the warehouse receipt example, you will see a warehouseman roll at full carry. There is no incentive for him to put it out. Now, that was, you know, the idea, the optionality behind that was to understand that, you know, if I sell boats today, if I sell vessels today for Oc Nov Dis, where do I put that hedge? If I put it hedge in the SEP, and then I actually cannot cover the cash and need to execute the September, it's going to take, I can't take it all out in the next day. I need some optionality to carry that. But I also need the optionality to carry it because if by doing that transaction, what do you really want to happen? You really want the market to respond. Premiums go up, the spreads narrow, the flat price responds, the farm removes a little bit of wheat, and the wheat flows because I've held on to that hedge and the market starts to be pushed in. But the market, on the warehouse receipt is the market of last resort. So if the dynamic relationship between the cash markets, the spreads, and the futures are working, that's why you should never have to really see a great deal of taking or making delivery. But if you have no optionality and you want to just take and force it onto the market and say you've got to move it out, well then that becomes burdensome on the other side. So when you look, it is a balanced contract that we're seeking, and so today this leaves the cash market, i.e. the basis, to compensate because of the fixed storage rate and because of the high amount of free stocks in our market. That leaves the cash markets the basis to compensate for the increasing demand for space over and above the fixed rate on the futures market, and has led to a lack of convergence facing the Kansas City wheat contract the past 12 months. The committee does understand the concern. The committee is working overtime to try to come to a consensus resolution on it, to provide a balanced contract, to not not make an irrational move that will have the unintended consequences that we fear. I'll just stop there, Mr. Chairman.
Thank you very much. I appreciate that. I had gotten a request from Josh Curley, who is a trader, to be able to make a short presentation, and Josh has done this in the past. So, Josh, if we can get you to kind of keep this short, so we're running way over, but I appreciate you coming in. Josh comes in at his own expense, and we greatly appreciate that.
Thank you, Chairman, Commissioners, and members of the Agricultural Advisory Committee. I will do my best. I'll keep this brief. While I'm certainly not qualified to speak on VSR's role in restoring convergence to the CBOT wheat futures contract, as one of the more active high-volume traders, I am confident in discussing the effect VSR has had on the deferred months and spread markets. To put it bluntly, spreads, especially past the second month, have become virtually untradeable. In terms of liquidity, they are thin and skittish. It's not a healthy marketplace. A healthy market is one where traders and customers can afford to be wrong, where they are able to offset a bad position and come back to trade another day. Currently, in our back month and spread markets, this is not the case. Lately, there is simply no out, making it nearly impossible to manage risk. Many of these spreads are not actually trading. What I mean is that there is no longer a natural progression where bids take out offers one tick at a time. We are subject to just violent repricings, often driven by relatively small orders. Liquidity makers like myself are exposed to several times the risk with a fraction of the position. I believe this is because VSR has destabilized our contract. Spread orders that were once absorbed by the market in 1 or 2 ticks are now moving at 10 or 20. Desk managers and floor brokers are reluctant to take orders past the first 2 months because positions are so difficult to get into and out of. Spread order books are a skeleton of what they once were. I believe the variable storage rate has created needless uncertainty. Going forward, 5 times each year, VSR will unnecessarily impose more volatility into our spread futures. What is worse is that by its design, VSR rewards rather than discourages market manipulation. Predatory funds that have the capital and ammunition will more easily profit if they're able to either hold the spreads above 80% or below 50% of financial full carry during the review period. While there has been a significant recent spike in volume and open interest, this merely serves the interests of the exchange. It would take an increase in true liquidity to benefit the core participants and the long-term viability of the market. These increases in volumes and improved ratios between deferred and front-month open interest have not meant greater liquidity. To me, liquidity is how easily you can execute an order with minimal price movement. Let's say you have to go to the market with 50 Dees July wheat spreads. It doesn't matter if you are a broker in the pit or a trader on the screen. This is vastly more difficult and more expensive to execute than it ever was prior to VSR. And there's not a single market participant that will tell you otherwise. And just real quick, a real life example because of what's going on in the market right now. If you went home yesterday with 50 Dees July wheat spreads on, which is not a huge position, you woke up today $100,000 poorer, and that's just mark to market. It would probably cost you another $20,000 to get out of that position in terms of market movement. Even if VSR has solved convergence, I don't know at what cost. The futures market is of no utility if you cannot trade past the front month. Again, thank you very much for your time.
Thank you, Josh. Commissioner Dunn had to step out for a few minutes, but he will come back, and I'm sure will want to engage in the conversations on wheat convergence. I'll turn it to my colleagues if they have any questions they want to ask this panel. Do you have any questions?
And I apologize because I had a meeting that I had to attend to, and I missed some of this, but so if I'm repetitive, I apologize. My question is what do we do to fix the problem? I thought the slides, maybe I'm complimenting our own staff, but Nicole, great slides, and whether you all accept, maybe my first question is everybody accept what Nicole writes on page 2. She has a little X and it says breakdown and linkage. I think when I was in Kansas City and I met with a bunch of people, I said it's a broken contract, and I didn't even coordinate with Nicole. But so my first question is do people believe that there is this breakdown in the linkage?
Well, Commissioner, certainly I think that, as I said in my presentation, the Wheat Contract Committee weeks ago came to the conclusion that that there is not a sufficient backstop mechanism in our contract to handle the types of situations we're in right now. Historically, we've been on the flip side. Normally, we have shorter supplies and we're worried about short squeezes, and so we're trying to formulate packages of changes to bring assets to bear and diversity on the market to compel convergence that way. We're not used to the situations that we're in now. Normally, we did have a little bit of it in 1998, but we worked through it pretty quickly, but we're just not accustomed to having the tremendous supplies and scrambling for storage space in the interior like we have today. So I think they understand that that there is an issue and that there needs to be some sort of a mechanism brought to bear on the contract to alleviate the stress and to compel convergence. And there's several different ways to accomplish that, and they're in the process of trying to flesh out those alternatives.
And I know we were all together, and I thank you for that. It was 4 or 5 weeks ago. It's a little bit of a blur. And at that stage, I think I'd asked you whether you thought you'd be ready by August 15th or something, but how long do you think you'll be ready before you have some firm recommendations?
I feel confident that we will not be ready by August 15th.
You mentioned that 4 or 5 weeks ago, and
the committee has had really good marathon, helpful discussions working towards trying to formulate consensus, which is really difficult because with the myriad of alternatives available to you, obviously you're going to have differences of opinion. You're going to have some that prefer one method for whatever reason and others that prefer a different method because of maybe some unintended consequences or whatever. So we're trying to work forward to come up with enough consensus to work down a particular path to flesh it out to see whether it's the right solution for our contract. And then at that point, once we have the mechanism decided on, then you can dress it up with other enhancements to the contract to create the requisite balance.
Will it be before the kids go back to school?
Which year?
No, more seriously, this year. I mean, I respect that these are challenging things, but and I expressed this in Kansas City, I'm just hopeful that you don't have meetings until, Christmas, and then, people go on holiday, and then it's meetings until the spring. And
I hope we don't have multiple meetings each week or twice a week before Christmas as well. But I think the committee, in my opinion, I'm there as an observer, have been since 1993. I sit in on all the meetings because I have to write the rules to accomplish what they decide. But I think they're making some good progress. I think that they're looking at alternatives that foster convergence either immediately or over time. And, I think most people can imagine what those solutions might be. It's either, we all know about variable storage rate, which I think taken by itself without the influences outside of the market, like the Russian deal or whether you're going to have a short crop or whatnot, taken just by itself would be, in my opinion, a more gradual solution over time as the spread widens out to accommodate. There are more immediate solutions, one of which I think the NGFA toiled for a couple years in putting together and recommending, and that was modified compelled loadout. I mean, compelled loadout or a modified compelled loadout or some variation thereof will effectuate convergence immediately.
Yeah.
So
I thank you, and I don't have any other questions really, but I do think that it's important for each of the contracts that the CFTC oversees that convergence works. I think it goes to the heart of the market mechanism and that wonderful chart that Nicole put together, that the cash market and the futures market for a certain number of days in the spot month should converge, and that's what farmers then ultimately get confident